Someone is in their mid-50s. They have worked for decades, paid their taxes, raised a family perhaps. Maybe they took a few years off. Maybe they were self-employed for a while. Maybe they worked part-time when the children were young. They log into Gov.uk one afternoon, check their state pension forecast, probably for the first time, and they see a number that is lower than they expected, significantly lower. And underneath that number, a list of years where their national insurance record shows gaps. The question they are now asking is, can I fix this? And if so, how much will it cost me? And is it actually worth it? The answer to the first question is almost certainly yes. The answer to the second is this. And I want you to stay with me until we get to the numbers in this video because they are going to surprise you. Filling state pension gaps is one of the best returning financial decisions available to any UK adult. The maths are genuinely striking, and by the time we reach that section, you will understand exactly why. But first, let me make sure the foundations are clear. Because there is a lot of confusion about how the state pension actually works. And that confusion is part of why so many people arrive at retirement with less than they are entitled to. The new state pension applies to men born on or after 6th of April 1951 and women born on or after 6th of April 1953. If you were born before those dates, you are on the old basic state pension system, which has different rules and different amounts. For everyone on the new state pension, the full amount from April 2026 is £221.30 per week. That is £11,502 per year. It is not a fortune, but it is a guaranteed inflation-linked income for life, and for most people it forms the bedrock of their retirement income. Every other source of retirement income sits on top of it, but here is the critical point, and it is the one that catches most people off guard. Not everyone receives the full amount. The state pension you receive depends entirely on your national insurance record. To receive the full new state pension, you need 35 qualifying years of national insurance contributions or credits. To receive any state pension at all, you need a minimum of 10 qualifying years. Each qualifying year adds a proportional share of the full amount. If you have 25 qualifying years, you receive 25 divided by 35 of the full pension, roughly £158 per week. If you have 30 years, you receive around £190 per week. A qualifying year means that in any given tax year, you either earned above the lower earnings limit, currently £6,196 per year, paid voluntary contributions, or received national insurance credits. National insurance credits are awarded automatically in certain circumstances: when you are claiming child benefit for a child under 12, when you are receiving certain disability or carer benefits, or when you are registered as unemployed and actively looking for work. If any of those applied to you in a given year, you may already have credits you are simply not aware of. Which is exactly why checking your record is the essential first step. Gaps in a national insurance record are far more common than most people realize, and understanding why they appear is the first step toward knowing whether yours are fixable. The most widespread cause is career breaks for caring responsibilities, and this disproportionately affects women. If you took time away from work to raise children but did not claim child benefit, or claimed it but had a partner whose income exceeded the high-income child benefit threshold, you may have missed years of national insurance credits that would otherwise have built up automatically. There is a specific situation worth knowing about here that catches many couples completely off guard. If child benefit was claimed in the name of the higher earner rather than the stay-at-home parent, the national insurance credits went to the higher earner, not to the carer. The parent who raised the children and stepped back from work received nothing toward their state pension record for those years. This is a relatively common situation, and it has left significant gaps in the records of many women who had every reason to expect those years would count. Self-employment with low profits is another common cause. If you were self-employed and your profits fell below the small profits threshold, currently £6,725 per year, you were not liable for Class 2 national insurance contributions. That year counts as a gap. Many people who ran modest businesses, particularly in the early years of trading, have gaps they have never investigated. Years spent living or working abroad do not automatically count toward your UK state pension unless you were paying into a qualifying scheme or benefit from a social security agreement between the UK and the country you were in. Periods of unemployment where you did not claim job seekers allowance or universal credit will not have generated national insurance credits, even if you were genuinely between jobs. Part-time work where earnings fell below £6,396 in any given year will not count as a qualifying year, even if you were employed and paying some tax. And years spent in full-time higher education after the age of 18 do not generate contributions or credits unless you were also working alongside your studies. Before you make any decisions about topping up, you need to know exactly where you stand, and this part is straightforward. Go to gov.uk and search for Check Your State Pension Forecast. You will need a government gateway account. If you do not already have one, you can create it on the same page. It takes around 10 minutes. Once you are logged in, you will see three things: your forecast, the amount you are currently on track to receive at state pension age, your full national insurance record, year by year, showing which years are full, which are partial, and which are gaps, and your state pension age, which matters because it is changing. It is currently 66 for both men and women, but it is legislated to rise to 67 between 2026 and 2028. When you look through your record, pay particular attention to years marked as gaps that fall within periods when you were working, caring for children, or self-employed. These are the years most likely to be correctable, either through paying voluntary contributions or by identifying credits you should have received automatically but were not applied. Write down every gap year. You are going to need that list. Now here is the section I promised at the start. The numbers that make this one of the most compelling financial decisions available to any UK adult. Each qualifying year of national insurance contributions adds approximately £6.32 per week to your state pension. That is the full weekly pension of £221.30 divided by 35 qualifying years. Over the course of a year, that additional £6.32 per week equals £328.64 in extra annual pension income. The cost of buying that qualifying year through Class 3 voluntary national insurance contributions, which is the rate most people pay, is £824.20. So you spend £824.20. In return, you receive £328.64 extra every year for the rest of your retirement. Your payback period is 2 years and 7 months. After that point, every single year you are alive and receiving your state pension, that £824.20 investment is generating a pure financial return. And here is what makes it even more powerful. The state pension is triple lock protected. It rises every year by whichever is highest: inflation, average earnings growth, or 2.5%. That additional £6.32 per week is not fixed in nominal terms. It increases in real terms every year, compounding the return further with every passing April. Let me put the full picture in front of you. If you fill 3 gap years, spending £2,472.60 in total, and you retire for 20 years, that investment generates approximately £19,700 in additional state pension income before any triple lockup rating. With typical annual increases applied over a 20-year retirement, the real return is likely to exceed £25,000. A £2,472 investment, returning over £25,000. There are very few financial decisions available to anyone, at any age, that come close to that. Now there is one thing I need to be clear about before you pick up the phone, and this is important enough that I want to say it plainly. Under standard rules, you can only fill gaps going back 6 tax years. Beyond that, the window closes. And because that 6-year window moves forward every April, every year you delay is potentially another gap year that becomes permanently unfixable. There was a special transitional arrangement that allowed people to fill gaps going much further back, linked to the transition from the old system to the new state pension. That extended window has now closed for most people, which means the 6-year rule is what applies now. The practical consequence is straightforward. If you have gaps in the past 6 years, those are your immediate priority. Act on them before next April, when the oldest of those years drops out of reach. There is also an important detail for anyone who was self-employed in any of the past 6 tax years with low profits. Class 2 voluntary national insurance contributions, the rate available to self-employed people, are significantly cheaper than Class 3. Class 2 contributions are currently £3.45 per week, rather than £17.45 per week for Class 3. If any of your gap years fall within a period of self-employment, it is worth checking whether the cheaper Class 2 rate applies before you pay the full Class 3 rate. Here is the step-by-step process for actually filling your gaps once you have identified them. Start by logging into gov.uk and downloading or printing your full national insurance record showing all gap years. You need this in front of you. Then, and this step is non-negotiable, call the Future Pension Center on 0800 731 0175 before you pay a single pound. The reason is that not every gap will increase your state pension. If you already have 35 or more qualifying years, filling additional gaps will not add anything at all. You are already at the maximum. Some gaps that occurred before the start date for new state pension calculations may also have less impact than you expect. The Future Pension Center can tell you precisely which years, if filled, would actually increase your forecast and by exactly how much. Only pay for the years that move the number. Once you have that confirmation, prioritize the most recent gaps first. They are at the greatest risk of falling outside the 6-year window. Then work backwards through the earlier gaps in order. HMRC will give you specific payment reference details for each tax year you want to fill. Payments can be made by bank transfer, check, or directly through your government gateway account. Keep a record of every payment you make. After paying, check your state pension forecast again within a few weeks. It should update to reflect the additional qualifying years. If it does not update within a reasonable time, contact HMRC with your payment evidence. Before I close, there are a few specific situations that come up regularly and are worth addressing directly. If you were the primary carer for a child under 12 but did not claim child benefit, perhaps because your household income was above the threshold, you will not have received the national insurance credits that come with it. You generally cannot claim those credits retrospectively. But you should still check your record carefully, because credits were sometimes applied even when the benefit itself was reduced or not paid. If you were married and your spouse built up national insurance credits through caring for your children while you worked, and you subsequently divorced, those credits went to your spouse, not to you. The impact of that on your state pension record is worth understanding, and a financial advisor with retirement planning expertise can help you model the full picture. If you are within 5 years of your state pension age, it is worth calling the Future Pension Center specifically to ask for a gap analysis given your proximity to retirement. HMRC will often prioritize these cases and can give you a clear assessment of your options relatively quickly. And if you have already reached state pension age and deferred claiming, there may still be options available to you depending on your circumstances. Contact the Pension Service directly on 0800 731 0469 for guidance specific to your situation. The State Pension Optimizer Inside Retirement. Ready UK lets you model the impact of filling specific gaps on your projected retirement income, compare it against the cost of contributions, and see how your state pension fits into your broader income picture alongside your private pension and ISA savings. It is a good way to sense-check the numbers before you commit anything. The link is in the description. Let me bring this back to where we started. The person in their mid-50s who logged into gov.uk saw a forecast lower than they expected, and found a list of gap years sitting on their record. For most people in that situation, the answer is clear. The maths are compelling. The payback period is short. The return over a full retirement is exceptional. And for many people, particularly women who stepped back from work for caring responsibilities, or the self-employed who had lower profit years, the gaps are fixable at a cost that is genuinely modest relative to the income it produces. But the window is not unlimited. The 6-year rule means that every year you delay checking your record is potentially a year you can no longer correct. The time to do this is not when you are 63, not when you are approaching your state pension age. It is now. Check your forecast on gov.uk today. Call the Future Pension Center. Understand exactly what you have and what you are entitled to. And if you want to see how the state pension fits into your full retirement income picture, alongside your private pension, your ISA savings, and any other income sources, Retirement Ready UK is built specifically for that kind of planning. The link is in the description below. Hit like if this was useful. Subscribe for more UK retirement planning content. I will see you in the next one.